Welcome to our daily bank reports review. This is for May 25th. So today, let's take a look at a bit of an overall view from one of the banks here. We have okay, so this is the report that I wanted to go over. Kind of cover some of the things that are going on at the moment here. So first of all, overall, Euro right now has been doing well. So last week we saw Euro did well, and the reason behind that was because we have seen the problem with the Eurozone is because it's made up of so many different countries, and each of those countries has different economies, so they can't always agree to the same thing because, for example, Greece is not doing as well, whereas Germany, France, some of these countries are richer countries and they're doing better economically than Poland and Portugal, Spain. Some of these countries are not at the same level in terms of the economics. So what happens is trying to put a package together that would benefit everybody becomes really challenging. Whereas with other countries like the US, Canada, Australia, New Zealand, all these countries, just one country. So it's just easier to agree to stuff, and we don't have, even though there may be differences between the different states and stuff, but overall one policy works. So this is why Euro was sort of under pressure because they couldn't put a proper stimulus package together because of these differences between the different economies. So last week we saw Germany and France come together, and they put forward a proposal for 5 billion euros worth of recovery fund. And this would actually use joint debt issuance to offer grants to member states fighting the COVID-19 pandemic. So they're not just giving out more debt, they're just giving out grants to these different countries that need help so that they can get through this time. And that is actually one of the best proposals that has come out of the Eurozone in the last little while. So there are a couple of countries who were not quite crazy about the proposal, but seems like it is overall a decent proposal, and most of the countries will accept it. So that's positive for the euro. So finally, there is a proposal in place that now the Eurozone can actually implement that and get past those problems. So that was a positive development for euro, and that's why we have seen euro go up last week. Now, we'll have to see how that goes through. It has to be voted in, and people have to accept it. So we'll see how things go with that. Overall, though, so far it's positive. And another thing that is having an impact right now is also the tensions between US and China, as well as US and Australia. So let's take a look at, actually, let's do them together first. Okay, so first of all, US and China. The part of the problem is the trade deal that was done. So phase one trade deal hasn't really been fully implemented by China because the demand in China has gone down. And as a result of that, we have seen our US has not been able to sell as much product. So President Trump basically said that he's not willing to renegotiate that deal, which means China has to buy the same amount of product that was set up in the phase one deal. Now, the problem that's arising here is that US has been blaming China for the pandemic, for coronavirus, and China doesn't like that. So not only is US blaming China, Australia is also blaming China, and pretty much everybody else is pointing fingers at China for starting this, and not just starting this. I mean, things can start. They don't really, now in forgetting about the conspiracy theories for a second here, they may not have had any control over that, right? A disease or virus can start in in any country. The problem is what everybody is not happy with them for is that they try to hide it. They did not bring it forward when they should have brought it forward. So in trying to hide it, they basically made the situation way, way worse than what could have been done previously. So that's what everybody's upset about. So U.S. is threatening China. So U.S. has taken a few steps in order to punish China, or President Trump is leading this effort. So some of the steps that have been taken is, one, a Senate bill got passed, or a bill got passed in the Senate, whereby basically some of the companies, Chinese companies that are listed in the U.S. stock exchanges, may get delisted, so they won't be able to sell their stocks in the U.S. And things like big companies like Alibaba, for example. And the reason they're using behind that are the accounting practices. That's the reason. But the point is that they're trying to make it harder for Chinese companies to list in the U.S. and sell to U.S. investors. Another thing is President Trump has asked many pension funds and hedge funds to not invest in Chinese companies. And part of that is, again, they don't want China to make progress. He wants those funds to be investing in U.S. companies, so that the U.S. companies benefit as a result of that, not Chinese companies. So those are a couple of the things. And then third one is Huawei, which is a technology company, and they use chips that are basically from U.S. companies. So President Trump has kind of stopped them from accessing that technology. And that one kind of falls under the whole privacy thing. So they're basically finding reasons to block this. So those are three things that are going on. Now, Australia and China, they are also having issues. And with Australia and China, the trade relationship is a little bit tighter because they are very close in proximity. Australia exports a lot of stuff to China. So first thing where China started, first of all, China said, we don't want Australia stop pushing towards investigating. So this is what Australia was doing. They were pushing for investigating the whole coronavirus issue, how it came to be, and how the situation was handled, that type of stuff. So Australia was really pushing hard. So basically China said, don't do this, otherwise there will be consequences. And Australia didn't care about it, so they pushed forward. And the first thing they did was that they put tariffs on barley. Australia sells barley to China. They put tariffs on that, and then they put tariffs on some meat products. So after that, they also, now they're kind of moving into other things that are more important to Australia. So agriculture products only make about 2% of the exports, so it doesn't really matter. However, other things like gold, coal, copper, these things are more important exports for Australia. And now this is where China is pushing back. So last week we saw articles where China or Chinese authorities have asked the state-owned companies to not buy coal from, or at least reduce the amount of coal from Australia, and either use domestic coal or find different place to buy that coal from. So that is going to hurt Australia a little bit more. Another thing that China has threatened Australia is that they will disallow tourism. So tourism is a big industry for Australia. A lot of Chinese tourists go to Australia, and it's billions of dollars worth of income that Australia generates as a result of that. But China has said that we are going to ban travel to Australia, or at least make it more difficult. So what China is doing is, or they have done in the past, is they will, a lot of times out of China, you'll see groups that go to these countries, right? So China can block basically these groups. So the people who sell tickets, the agencies, they're not allowed to sell group tours to go to the countries that China has banned. So they can do the same for Australia, which will be a big hit for Australia. Another thing is a lot of Chinese students go to study in Australia. Again, that industry is worth billions of dollars there. So if China stops their students from going to Australia, and they either force them to go locally to Chinese universities or go somewhere else, that would be bad for Australia as well. So we'll see how this develops. But this is another geopolitical issue that is going on at the moment that we have to be careful about. And then, of course, we have Hong Kong is another geopolitical issue that's going on right now. So last year, you may have heard there were a lot of protests because China. So China is a very closed off country, and Hong Kong, on the other hand, was more democratic. It was ruled or under British rule. Just recently, in the last few years, they have actually become independent of the British, and British basically passed the country over to China because China is essentially who had it previously. So the economies and the way of life is very different in Hong Kong than it is in mainland China. And so there was, when China first took over Hong Kong, there was this whole concern that China is going to implement their own policies in Hong Kong. But Chinese authorities said that no, we will let Hong Kong be the way it is. You can continue running just your life the way you run it. Now they're backtracking from that. All the protests that we saw, basically Chinese authorities were basically trying to bring Hong Kong under the Chinese rule, according to the Chinese way of doing things, the way they run their country. And Hong Kong citizens didn't like that, and they were protesting around that. So that was starting to become a political issue last year. There were a lot of protests. There were a lot of, and the Chinese authorities were trying to kill those protests. So they were able to reach some sort of an agreement. Now, under this whole pandemic issue, basically what China is saying that we are going to put some security measures in place. Those security measures are basically going to convert Hong Kong to China's way of doing things. So basically, it will become very restrictive, and that is a problem. So as a result of that, we did see the Hong Kong markets have dropped. Now, we haven't seen the same sort of, initially there was a drop off for both China and there was a drop off in Chinese markets, in Nikkei, in Hong Kong, and S&P, and all the other indices as well. But right now, that's not the case for others. But the Hong Kong index will still be impacted, and we're likely to see a drop in that because there will be a flight of capital. So basically, because this is a big risk, and China has a just different way of doing stuff where state owns pretty much everything, and the state can kill your business if they wanted to. So there will be this flight of capital where people will take the money out of Hong Kong and go invest it in different countries where it's safer. So there will be a lot of that, and because of that, people will be selling their securities and stocks and stuff like that. This is where the Hong Kong market is dropping. So if you're interested in selling, or if you're interested in trading that, basically there's a lot of risk right now. This is why the index is dropping, and you can take a look at that. But that can then go out into the different indices as well. So previously, President Trump had said that they are going to not stand for that there because it's a human rights issue. U.S. is going to support the protesters. Now, China has basically told U.S. to back off because this is a domestic matter, this is an internal matter. They will take care of their own business and not to butt in. But to appease the U.S., they said, we are going to honor the phase one trade deal, and we will do everything in our ability to purchase those products that they had committed to. So that's a way to appease U.S., while at the same time they get to have their way, which is basically they want to overtake Hong Kong and bring it strictly under their rule, and they're going to get to do that. So far, we have seen that U.S. has condemned China for this, but they haven't been very vocal about it, and they haven't really. They have filed a complaint and this, that, and the other, which is not that, in the grand scheme of things, China doesn't really care about that. China will care if President Trump comes out and say, well, this is wrong, we're going to take some action, and we're going to put sanctions and tariffs and so forth, which President Trump has not done. And right now, because we are in that election year, President Trump has to be very careful. So we'll see how things flow. But China recognizes that, and they're trying to take advantage of not just the pandemic, but also what's going on internally in the US politics in order to make the best of the situation for themselves. So basically right now it's a wait and see. If we take a look at the markets right now, we see that S&P 500 is going up. We see NASDAQ is going up. We also see Dow Jones going up. So overall, the stock markets are still going up at this moment. But should this change in the coming week, we have to be prepared because things can change. And this is where the risk off mode can come into the markets. So right now, what is driving stocks markets? Two things that are driving stock market. One is this positive optimism in regards to opening up of the different economies. So around the world, we are seeing different economies open up. Everybody has like a different phase plan. Canada has a 4-phase plan that we are implementing here, and so do other countries in terms of opening up of the economies. That's a positive thing because markets are now expecting more consumer demand, more money going around, people going back to their jobs, businesses going back into their day-to-day business. All of that is positive for the stock markets, and that's a positive thing. Another thing is the money is at all-time cheapest levels ever. We have not seen these type of interest rates ever, essentially, ever since I have been in this or I've heard of it. We haven't seen this, not in our economy. So Japan, yes, they're at a negative rate. We have not seen that here. And right now, businesses can borrow money at a really, really cheap rate. When businesses are able to borrow money at really low rates, then they can use that money to invest in the business, to make some capital investments, build factories, buy machineries. They can pay their employees, and they can basically focus on growth projects as opposed to other stuff, right? So this is where we have to take a look at the businesses are able to focus on larger investment projects, which means they're working towards a future growth, which is a positive thing, and that actually has a positive impact on the stock market. On the other hand, we have Fed, who is spending a lot of money in the markets. They're providing a lot of liquidity. They're buying securities, and they also started buying corporate bonds. So they're actually providing a lot of money in the markets. And when that happens, the stock market tends to go up because there's all this money coming in, and then that creates an expectation that everything will go up. So different central banks and around the world are supporting the markets, which are making the markets go up. So those are some of the reasons that we are seeing the markets go up. Now, the risk will be if the number of viruses and deaths go up as a result of opening up of the economies. We have the second wave of viruses. All of that will have a negative impact on the market, and we could go back into this risk-off scenario, which is not right now. We're not seeing that. So there are several different things that could push us into that environment. So the U.S. and China trade relationships, U.S. and China fighting over Hong Kong issue, human rights issue, that could be problematic. China and Australia, that could be problematic. So some of these things can push the markets into risk-off mode. So just be prepared for that transition. If that happens, we just have to know that stock market drops, which means our dollar crosses as well as yen crosses are likely to drop with that as well. So this is what the bank has to say here. We continue to worry that at some point in not so distant future, the bad news hitting the markets would reach a critical mass and push the risk rally into reverse. So we'll have to keep that in mind. And then in that case, like I said, our yen crosses are likely to drop as well as US crosses because money will start moving into the safe haven assets or safe haven currencies, which is your US dollar, Japanese yen, and gold is also a safe haven asset. Now, gold has kind of gone back and forth right now in the recent months here in terms of safe haven versus not safe haven. What has happened is when the market essentially dropped initially, the reason gold and silver dropped with the market was because the funds or the big traders had to sell everything in order to avoid margin calls. And that's why we saw gold drop as well. But generally, we see that when markets are dropping, stock market is dropping, gold tends to do well. So now now we have started seeing gold kind of move in the opposite direction of the markets at times. So right now, it's kind of going back into that relationship, and before long, gold will be back into the safe haven, into becoming a safe haven asset. So we have to keep an eye on that. So what they are suggesting here is that in their portfolio, they are saying they are short Aussie yen because Australian dollar is directly related to the markets. When the stock market goes up, Australian dollar goes up. And when stock market drops, Australian dollar drops. So when we go into this risk-off scenario, being short Aussie yen would be a good thing. Long gold against the US dollar, that would be a good thing. And they're also long Euro Swiss franc. So those are the three trades that they're suggesting once the market goes off into this risk-off mode. So let's take a quick peek at what they are saying in terms of these different currencies here. So we'll take a look at FX and gold outlook. So in the currency markets, first of all, with the Eurozone, we expect the US to outperform the Eurozone during COVID-19 induced global downturn. So they are expecting Euro to not do so well. And they are thinking that the Eurozone's underperformance is made worse by persistent widening of the peripheral spread. That will continue. So this is where the different countries have, like Italy and Portugal, these countries are not doing so well. So we expect some downside risks for the US dollar to start emerging around the US presidential election in Q4. So we'll have to look at that fourth quarter and see what happens with the US, because there will be too much uncertainty and too much risk in the market, and markets don't like that. So in the fourth quarter, we may see the US dollar drop, and this could temporarily pop up the undervalued and oversold euro dollar. So further out, however, the downside risks for euro US dollar could return. So what they're essentially saying is they think US dollar will do better than euro, except for Q4 of 2020, when we have the presidential election in November. And once that's behind us, again, the US dollar is likely to outperform the euro. So this is a bit of a longer term view on euro. US dollar. All right, so the US dollar could remain close to the recent highs in the coming months. And their main reason for this is the expectation that the US economy could perform better than other G10 economies during the COVID-19 induced global recession. And then US dollar could also benefit from superior liquidity and its role as a safe haven, especially versus less liquid commodity related currencies. So this is where they are expecting US dollar to do well, essentially. And the key uncertainty for the US dollar remains the outcome of the US presidential election. So as we move towards November here, we will start hearing more about the presidential election and what impact it will have on the US economy as well as the US dollar. And we expect the currency will lose some ground going into second quarter of 2020 against other liquid currencies like euro and yen. So for 2021, We continue to expect a renewed US dollar rebound, assuming that the President Donald Trump is re-elected and the US dollar positive policy mix of supportive fiscal policy at home and aggressive protectionism abroad stages of return. So if things continue the way they are right now, essentially what they're saying, we are likely to see a stronger US dollar in 2020 and 2021. Swiss franc here. While the Swiss franc has been in demand for most of the year, we advise against chasing the currency higher. So we have already seen that Swiss franc has done well because it's also one of the safe haven currencies. But the problem here is, like they say here, persistent currency strength at these levels only increases the risk that SNB, Swiss National Bank, will consider additional policy action later this year. And also, Swiss National Bank is notorious for intervening in the market. Anytime they don't like the strength of their currency, they will go and sell a whole bunch of currency. They don't tell anybody. They just go and do it, which basically helps them maintain a lower currency strength. So they don't want the currency to be so expensive. Just like Japan doesn't want their currency to be too expensive because it's bad for exports, because their exports become very expensive for everyone, and then it drops the demand for those exports. So they don't want their exports to be expensive. Okay, so while the coronavirus has led to a shutting down of the US economy and dramatic reduction in rates by FOMC, the US dollar is being supported by safe haven with yield appeal, as well as prospect that the US economy will withstand the coronavirus better than the rest of the G10. So that's basically the base case that they're looking at. The weaker global economy, as well as Japan's policymakers relying more on fiscal rather than monetary policy to combat the economic impact of the coronavirus, will keep the Japanese yen well supported. We have seen that. So if you take a look at the Japanese yen charts, we'll see that that Japanese yen has done well. And also we see when the market was dropping, the stock market was dropping, yen crosses were dropping. So this is where the stock market fell. And as we can see, yen crosses dropped as well because Japanese yen became stronger. So, so Japanese yen is another safe haven currency. And if the risk remains in the market, Japanese yen is likely to do well. And this is what they are saying as well, that Japanese yen will be strong. UK. All right, so we maintain a cautious near-term outlook for British pound in view of the very negative growth impact of COVID-19 pandemic on the UK economy. The prospects for the currency are further made more complicated by persistent Brexit uncertainty and the economy's weak external position. So another thing that's going on there, with Brexit, they need to essentially make a decision on postponing the deadline. So far, the deadline has not been postponed of the actual Brexit happening, which is supposed to be this year. But if they do postpone the Brexit transition, that will be positive for British pound. But until then, Brexit is going to cause further strain on UK and British pound. Now, another thing that we are hearing, which is will have an immediate impact, or is having an immediate impact on British pound, is that the Bank of England has been talking about negative interest rates. And negative interest rates are not a good thing for anybody. So what it does, it will have a negative impact on the currencies. This is why we have seen British pound drop. So if Bank of England does go negative on the interest rates, we're likely to see a further impact or negative impact on British pound. But by the time they actually get there, that may be priced in. So we may not see as big an impact at the end of it as we are likely to see leading up to that decision, which will be in June. So from now to June, we may see British pound drop. So keep that in mind. And then Canada here, the current recession in Canada could surpass the 2015-2016 economic downturn, with collapse in oil prices depressing business sentiment for longer, and the COVID-19 pandemic triggering a surge in unemployment and having a pronounced negative impact on domestic demand and GDP growth. So I agree with that. So, and we see that the Bank of Canada is quite dovish, and they are saying that they are going to keep the interest rates low for the foreseeable future, at least into 2021. So as a result of that, they are saying that the Canadian dollar is likely to stay low. However, that said, the latest CAD sell-off has already pushed the currency into deeply undervalued territory versus long-term equilibrium value. This could limit the prospect for sustained further currency losses. So Canadian dollar is likely to stay low compared to the US dollar, but because with the oil dropping so much, it's already dropped quite a bit, we may not see as much of a difference from these levels. So just keep that in mind. And then we have Australia. China's stimulus measures will help Australian economy via increased demand for their commodities, but less so than during the GFC, given that China will be spending less in order to avoid further buildup of leverage in the economy. So we'll see. We'll see how that goes, but any money that China spends in their own economy to increase demand will also increase demand for Australian products. So that's a positive thing for Australia. However, on the other hand, if Australia's problems with China continue, that will be negative for Australian dollar. So on one hand, the money that Chinese authorities are spending in China is a good thing. On the other hand, we are likely to see a negative impact from the relationship sort of falling apart there. So this is something that we'll have to see how it plays out, but something we have to be aware of. New Zealand, in order to contain the coronavirus, New Zealand dollar entered one of the harshest lockdowns in the world. And New Zealand's economy is also disproportionately exposed to the economic impacts of the virus related to other G10 countries due to its large tourism, education, and service sector industries. So same thing as Australia, we see that New Zealand also depends very much on the tourism and education and service sector industries, and that will be negatively impacted. And then Reserve Bank of New Zealand has also said that they may go into negative rates territory, but in the last week that they also came back and said that that's not immediate and that may or may not happen. And as a result of that, we have seen New Zealand dollar go up. So we'll see how this one goes as well. But basically, in a risk-off scenario, New Zealand dollar will sell with Australian dollar. But if the stock markets continue to doing well, we're likely to see both Australian dollar as well as New Zealand dollar go back up. Okay, so NOK here, the threat of Norges Bank's intervention coupled with its having reached the lower bound is likely to limit NOK downside risk from here. We target Euro NOK at $10.20 by the end of the year. All right, so with the SEC here, the Riksbank unlikely to consider lowering rates anytime soon, and we expect fundamentals to rebound in the second half of the year. Our long-time view on SEC remains constructive, so they're looking for SEC to go up. All right, last one here. Gold, the low interest rate environment coupled with global central bank focusing on liquidity provisions is likely to keep hard assets such as gold attractive. We expect gold to head higher into the end of next year. So it looks like they're bullish on gold and they're expecting gold to go up. Now, having said that, though, we may see gold drop in the short term before it starts going up. And that is likely to happen when the stock market drops before it kind of picks back up again. So just be aware of that. They are expecting gold to overall be be high. Now, gold is also an inflation hedge. So with so many countries and central banks basically throwing money and printing money, this is going to devalue a lot of currencies and lead to more inflation. So when that happens, when the central banks are printing so much money, generally we see that gold tends to go up. So gold is an inflation hedge, which means that instead of keeping money as hard cash, if you buy gold, as the US dollar drops, for example, the gold will become more expensive. So it will be your money that you're putting aside, basically, if you put it in gold, is a better way to go, because let's say today you saved $1,700, which is what gold is worth at this point, and tomorrow gold goes up to $2,500, your $1,700 is still worth $1,700. But if you had bought gold, gold goes to $2,500 an ounce. Now you would need more money to buy gold, whereas if you had put that $1,700 into gold, your $1,700 is now worth $2,500. So this is how you can play the inflation, or use gold as an inflation hedge instead of saving money in cold hard cash. You may want to consider investing in gold. So just a thought there. And then this is their portfolio. We'll take a quick look at what they are invested in at this point. All right, so discretionary portfolio. They are long Euro Swiss franc, long gold against the US dollar, and short Aussie yen. And their targets are here. So if you're listening to this on the audio podcast, I suggest you check out the YouTube to actually see the figures that they are looking at. So again, this is not an investment advice. This is just the figures that they are looking at in their portfolio. So not investment advice by any means, but please take a look at it if you're interested in it, and then use your own analysis to see if this is something that you may be interested in. So some of the other trades so right now, those are the 3 trades that they have going. Yeah, so that's it for the targets. So those are the 3 trades. So that's it. I just wanted to basically share this with you. Actually, they have another exchange rate forecast. So what are they looking at? Euro dollar in June of 2020, they're looking euro dollar at 1.09, which is about where it is right now. In September, they think it will go up to 110. In December, they think it will go up to 111. And March 21, still at 111. June 21 at 110, September 21, 110, and then December at 110. So 109, 110, 111 is sort of where they are looking in terms of the euro dollar. Japanese yen, looking at 107 for June 2020, 108 for September 2020, 109 for December, 108 for March 21, and then June 2021 is 108. September 108, and December 2021 is 110. So they think it will go up. Pound, in June of 2020, they're looking at 1.22 as the price. They think it will go up in September, or by September. And in September, they're projecting the value to be at 126. December, it's likely to go even higher, 129. And then March, they're thinking at 131, March of 2021. And then they're looking at a decline essentially again in June. And then in September of 2021, 132, and then 133. And let's take a look at Aussie dollar. Right now, they're looking at 61 cents, September 2020, 62, December 64, March 2021, 66, June 2021, 67, September 67, and December 68. So if you are interested in this, you can just pause the video here and take a look at it. Or if you're listening to the audio, like I said, please go take a look at the YouTube channel. Just do a search for Trading with Venus and you'll be able to find it, and take a look at the bank report. And then gold here, we'll wrap it up with gold. Gold currently, they're looking at 1720. September, they think it'll be 1760. December, 1820. March 2021, 1840. June 1840, September of next year 1860, and then all the way up to 1880 in December of 2021. So they think gold is likely to continue going up. So, all right, so that's it for now. Just wanted to do a quick overview of what Credit Agricole here is taking a look at in terms of their forecasts, how they're viewing the market currently. So again, not investment advice. This is just their projections that I just wanted to cover. It's a good idea to see what the banks or how the bigger institutions are viewing the market. Of course, having said that, things change. Markets are dynamic, so do bear that in mind. But this gives us an overall view of basically what's going on in the market and what's impacting the prices for now. So I'll wrap it up here. You guys have a wonderful trading week, and I will see you next time. Bye for now.